Today, what I wanted to talk about is some things that I didn't think would be covered as much. You've got a lot of material. These are great presentations today. We're involved in a lot of conferences. We actually, Corum is involved directly or indirectly in almost 100 events a year. So we see a lot of stuff, a lot of information, a lot of content, a lot of speakers, and I've been very impressed with what I've seen today. A little bit about timing. When should you sell? That came up but wasn't necessarily answered. Process, they talked about from the buyer's side what they're looking for, from the seller's side what they're looking for. How do you build that bridge? How do you make that connect point? All right. Deal disasters, people talked about that. M&A roadkill sometimes, as we call it. And then how do you leverage this process for maximum value? Before I get into this, I'd like to thank the sponsors, the co-sponsors, GeekWire. Guys, are you here? Are you still here? WTIA, and especially Davis Wright. I've known Davis Wright for a long time. They built one of the first technology practices, Peter Parsons, and they helped me build what ended up being the world's largest vertical market software company. When I founded WSA, which is now WTIA, Peter Parsons and their group stepped up, and they were the largest single funder of the organization, because without those guys, you just can't make these things go. And the first purpose of the WTIA was to create forums like this, and so they got involved in a lot of educational forums. Later, that was in '84, later in 1990, I started a conference called Selling Up, Selling Out, and some of you have been to that conference, and that's a definitive boot camp on how do you go through a merger from beginning to end. And I'm going to give you a brief overview of that today, a few slides. And guess who stepped up again? I had Price Waterhouse as a global partner on the accounting side, needed a legal partner. Again, we had Davis Wright. And then in 2000, 10 years ago, I was approached by KPMG and some others to kind of fill a void, bringing technology and finance together in the World Financial Symposiums. We need a legal sponsor. Guess who stepped up? Davis Wright. So these were forums that were local, regional, U.S., and global, and they've always been heavily committed, that word we saw today. One of the things that's different, those were conferences for different generations. But it was interesting. I was taking notes today, and the words that I wrote down, we had KKR, we had so many great speakers. Quick deal is a myth. Talked about advisory boards, trust, do it right. You never get a second chance. Competition is essential in the process. They have your, somebody practice your presentation, good planning, preparation. Coaches, advisors, I would add mentors. Be upfront, long-term relationships, no bad apples. Emotional sale, that's interesting. Trust, respect. How do you build that? We need to know these guys. We may buy into the company, but we don't buy into the founder. Big companies don't create new technologies, don't hide stuff. Trust is the most important thing we have. Bad news must travel early. Arrogance, committed versus involved. What's interesting is that this is a conference about change. That is not new stuff. That's old stuff. And in some ways, in this day where we get way too much information this day and age, these things like trust and understanding and good communication are even more critical. I love the one about dead horses. What's interesting is when I started this business at Corum, when you raise your hands, how many raised your hands for an IPO? I think one person. When they asked the question, I think Ward asked the question, how many of you think you'll go through an M&A event? A lot of hands went up. That's been one of the fundamental changes from then to now. Okay, the companies were different then. There were a lot more technologies, but a lot of things are the same. These new technologies, some things have been remained the same, but they just renamed them. But what's interesting is that the game has changed. We don't think we're going to go public. I remember when I went out and got $11 million funding, which that was a first for non-underwritten funding, and they kept saying, "What are you going to do? We're going to go public." I didn't know anything else to say. When I started Corum, it's interesting, we would get the dead horses because the venture capitalists figured that if it didn't work, then they're going to sell it. So you ended up tending to get the dead horses from the venture capitalists. We called them something else. Today it's different. A lot of us look at an M&A event as a way we're going to have an exit. So let's briefly fly through, because we only have a few minutes before we go to wine tasting. There's a life cycle. And a lot of you, if I asked you, when are you going to sell it? When I'm ready. where are you in this life cycle? There are times when there are premiums. There are times when your value is lower. This is the valuation life cycle. I'm going to give you this whole report, so with notes on it, so you don't have to take any notes. But where are you in the life cycle? And where are you in the top trends? What happens is, and you've heard this from the speakers that just came on, you're kind of surfing the trends. You sell because somebody needs to position in the cloud or SaaS or big data or something. Gartner's got 10 trends. Which ones are you in? Mobile? Apps? The cloud? And it's interesting. Cloud was 10, then 1, back down to 3. Internet of Things, hybrid IT, big data, which we're going to have a special report on. Rob, I think you're doing that later in next month. Analytics, mainstream and memory computing, integrated ecosystems, and enterprise app stores. What happens is that the big companies themselves today are really a collection of acquisitions. I just talked to Rob Adams. We're getting him to try to speak from Cisco. 370-some acquisitions. Microsoft, Google, all these guys. There's really a collection of acquisitions. That's where the new hot stuff is happening. Like the presentation is given by Gary. That's where the action is. They have to buy them. In terms of valuation and what's important in your company, you hear about technology, and that's absolutely true. But there's other things. Do you represent domain expertise, all right, as an ongoing company? Talent, technology, sales channels, revenue, earnings. There are lots of things there that you represent. In some cases, it's better for them to buy you and to get all the experience you've got, those thousands and thousands of communications and all the mistakes you've made, than try to do it themselves. And that's why we're seeing even some very small deals being done. There's 10 reasons why we think it's going to be strong in 2013, similar to what we saw in 2012. One, all these interrelated changes that are going on. There's more disruptive change now than ever. And that just is a lot of churning. People, it's interesting, we had a webcast, a global webcast 2 weeks ago. And who was the guy, Nat, from Google? Yeah, he said that, help me out, the Kickstarter, they're buying into companies without even really knowing them now, just to get in there and get a position. So we're seeing it's kind of like the old days in a way. They have record cash. Debt is the lowest cost ever. You heard one of the guys from, I think, Microsoft say they can go out and raise money. You know what the coupon rate is they pay at Microsoft and IBM and all these companies? Help me, guys. What is it? 0. 0. They don't pay any interest at all. Just convertibles. Private equity over $1 trillion. New public foreign buyers. A lot of markets stayed active even during the recession. They produce newly minted public companies they have to buy. Entrance of non-technology buyers. This has been an interesting phenomenon. We did a deal with Bosch and Japanese company Brother. Yeah, you wouldn't think of them as being traditional strategic buyers, but they outbid the world on deals. And with Bosch, it's because they make all this stuff that they're going to put intelligence in. Whether it's a washing machine or something for your car, it's going to be the Internet of Things, 50 billion in the next few years. It's a different world. And so you see some large, non-traditional players getting into this, making acquisitions. Crowdfunded, original crowdfunding, Facebook Zynga Groupon, but the new Jobs Act gives us a new wave of buyers. What are they going to do with the funding? Go buy somebody. American companies are very cheap to foreign investors, very cheap. The euro this morning was 135. At one point, the euro was 82 cents to the dollar. 135. That makes the U.S. dollar very, very cheap. We're on sale. Most of the tech companies are still here. We're on sale. The only currency that hasn't increased relative or dramatically relative to the U.S. dollar is which one? Mexican peso. So buy pesos. Strong financial markets. They're debating this morning. We're just close to a new top. The other foreign markets, such as China, are coming up. Software is rising in importance. And we're seeing, I want to emphasize this excess cash. Look at this. This is during the recession, what happened to cash in these companies. What happens if you're sitting on 100, and these numbers are even a little low. If you're sitting on 120 or 70 or 30 or whatever $billion, what do you do with it? What do you do with it? Well, you give a dividend. You're doing a little bit of that. You buy back your stock, or you buy something. You can buy a lot of stuff. I just saw this morning where Microsoft might be co-investing with Silver Lake or somebody to buy Dell. It's hard to find big enough stuff to spend that much money. But you also heard the concept introduced earlier this morning about these holding companies, or basically where maybe you're too small for a private equity firm to invest in, but they'll buy through a company. We're seeing a lot more of that. So how much do they have? $350 billion they have to spend. And as I mentioned earlier, how much do the private equity guys have? Almost 3 times that amount. And they just keep raising it. They just keep raising it. Where are they going to spend it? So getting the highest value, now we'll talk about building buyer bridges. And this is a presentation that's from our merge briefing. Some of you have been to that. Our primary conference is Selling Up, Selling Out, which is the boot camp on how to do this. That's a day long. The merge briefing is an introduction. That gives you valuation metrics, deals that are happening, and an overview of the process. I've drawn a few slides from that. How many of you, by the way, attend our monthly webcasts, or annual or quarterly? Yeah, what's really interesting, it's probably only about 10 or 15% of the audience. That always surprises me. We have all these conferences are live, and then online, a lot of people don't attend the monthlies, and I really encourage you to do that. The people like you saw today, people that are sellers, the buyers, the private equity guys, the newsmakers, the metrics on valuation, what structures are working, and then special presentations on the markets. That happens every single month, and it's fresh with the most up-to-date deals that month, okay? We just had Google, Salesforce on our annual report. There were 700 people from 36 countries that signed in. So if you thought today was useful and there was some good pieces of information out of this, I would encourage you to get online every month. So a little bit about this. They talked about, we're buying and you're selling, and you kind of say, well, do I have to know one of you guys to get to these buyers? How do we do that, okay? Well, there's a process. When I started Corum, I built a successful company, Accountants Microsystems. It was very tight models. And I found that a process was crucial. A lot of times these deals would be done and kind of shooting from the hip. You make a few phone calls. There's, I think these are the guys with bias, that sort of thing. And you've heard stories that that's not the case. In fact, it's almost never the case. I think it's going to be Microsoft or Oracle or Google or somebody's going to buy it. And it may be a firm you've never heard of. And that's what we find, by the way. It's really interesting. And the universe of buyers has expanded dramatically. But to get to these guys and to not go through all the problems you hear about, you have to have a process. What we call is the 8 stages for optimum outcome. And briefly, and I'm not going to make this totally instructive because I'll send this to you, but set your tasks and timelines and how much this is going to take, what kind of information. It's really self-checking due diligence. Think about that. Marketing plans, financial plans, presentation materials. Begin collecting due diligence materials. Plan this up front. What the last panel said, it was useful for us to get ready for this. What do we have in contracts? What are we going to need? What are the buyers going to ask for? Research. Who are the buyers? And this is the A and the B level. There are far more buyers now than ever. And you don't even know a lot of them. Nat mentioned that he sold a company to Intel. What he didn't tell you is where the company was. It was in Seoul, Korea. We just sold a company to China. We just sold a company in Japan, or to a Japanese buyer. The buyers are everywhere. They're not just your regular, normal Class A buyers. A lot of them are firms you've never heard of. Plus, we have the investment firms, the holding companies, private equity, and in some cases, non-technology firms. It could be anybody in your food chain now. So you have to do analysis on each buyer, customized presentation. You'll have valuations. You're going to have to make sure you get the proper contact, influencers, et cetera. And then there's contact. How do you contact these guys? Some of these firms require that it's electronically submitted online. They have a very detailed process. Who do you go to? And how do you go to it? What should you say? What will you need in terms of NDAs, that sort of thing? What kind of communications? What can you expect? Then there's a process called discovery. Really, this is a form of mutual due diligence, but we're borrowing this from our friends in the legal community. Discovery, you're getting to know each other, all right? Site visits and review process, and some initial discussion about valuation, but you're going to wait for a while on that, all right? You want to kind of set the hook. You're growing. You want them to fall in love with you, all right? Analysis, that sort of thing. You want to finish buyer due diligence. Then negotiations, all right? Your visits and auction, you're trying to create an auction environment. We'll talk a little bit more about that. Negotiate with your top bidders. You want to be talking to everybody. This is the most important transaction of your life, period. And I'm always amazed that people will contact us and say, hey, Nat or Ward or Bruce, listen, I've just been approached. I'd say 70% of the companies that we work with are that way. And you heard that earlier. Most firms, the process was initiated by somebody approaching them. I've found that somebody approached me, and I want to can you guys just kind of help us get over the goal line and negotiate this deal? We won't take them on. First off, the first approacher is usually somebody who's a bottom fisher. And they're going to completely control the negotiations if you do that. You need to, at this point in your life, it's the most important transaction of your life, bring in other parties. We'll talk a little bit more about the benefit of that. There's the LOI, the no-shop, which you've heard about. That's your leverage. Then you get into formal due diligence, and this is where the landmines are. This is where it's really tough. This is where the deals fall apart multiple times. It is very, very stressful. Because of the new laws, Sarbanes-Oxley, due diligence, is no longer... Today, if they don't do their due diligence and there's a problem, it surfaces and it can be a criminal filing against the buyer. All right, so they have to do their due diligence. You have to map against business methodologies. You have to develop the definitive agreement, go through due diligence. And then you have closing and integration. The integration, the whole process of integration and negotiating for integration starts at the very beginning. Will you relocate? Who do we have to keep? How are we going to keep them? Are there stay bonuses, completion bonuses, stock options, that sort of thing? You have to think about this stuff right up front. So that's the process. That's how you go to these companies. It requires a lot of research. You're going to, who might buy you, the A and the B list, global list, that sort of thing, and who do you go to? Now let's talk a little bit about avoiding being a deal disaster. You've heard some of this today. The guys talked about what percentage of the companies they invest in. It's a very small percentage. Further, we heard about what percentage of them make it. The number I've heard is like 10%, that actually create some kind of serious success. In our business, if you look at self-managed transactions, what do you think the failure rate is? If you take your company to market, what's the failure rate?
80.
Yeah. It maps exactly to the rest of it, the investment and other rates. And so people, it's interesting. They say buyers, well, we buy and a lot of these deals don't work. The percentage of deals that don't work, by the way, is 53% according to Ernst & Young. But that's a lot better than trying to start up and do an internal process. And if you have a technology and you want to do it with your own staff, the failure rate's about 90%. So acquisitions are still way ahead of the game. But people who go to market, most of them don't make it. How do you improve the odds? You need a process. So first thing, qualify the buyer. It's amazing the number of people who get involved in serious dialogue. They expose themselves. They kind of put their business on hold. They haven't even qualified the buyer. Why are you interested? What acquisitions has your company done? What is your preferred deal structure? What is your approval process? Who is involved in the decision making? How do you see our company fitting into yours? This is asking questions. By the way, the buyer is going to tell you why they like you. You have to actively listen, though. Stop talking. No, just stop talking. Why are you interested in us? And they may see you a different way, and they may not see some of the things about you that are maybe even more valuable. How can you fill a need for them? You have so many ideas. You built a company, that's made great technology, sells globally. You're doing amazing things, beating competition. You're the entrepreneur. The guy on the other side probably is just a business development person, maybe came through marketing or finance or accounting. All right? You're the one that can make things happen. You will see a vision with them, and they'll start to get excited about what you can start to do together. But not if you don't listen. What's your integration process? Do you have outside advisors? How did your acquisitions work out? Can I talk to them? That'd be nice to know. People underestimate the amount of work. We have a board called the World Technology Council. And the World Technology Council basically includes people that we've done conferences with, industry experts, former clients, that sort of thing. And so we asked them, what are the things that were involved in the process that you thought were the most important? We came up with 60. And then we asked them, which ones can't you do yourself? That's these. And I won't read these to you, but it's all the things you have to do to go through the process and be successful. Next 20. By the way, as you get closer to the end, there's more in red. There's things about, for example, do you know valuation methods? Do you have the lists of comparables? A lot of this stuff's hard to get. You can't. It's hard to do valuation reports, that kind of thing yourself. And this last group, outside opinions, agreements, employment agreements, hard to negotiate for your own non-compete, patent analysis, security agreements, registration, that sort of thing. So there's a lot of work. And there's a lot of deal killers. First off, number one, I keep coming back to it, dealing with only one buyer. This, to me, is the biggest single mistake that happens. People get approached. They want to get the deal done with that group. It's never optimal, ever. Misalignment of shareholders and employees. I'll bet the people up here could talk about maybe there was some misalignment. Other executives in the company or investors, whatever. And you saw this little role playing here. They were misaligned there, all right? And maybe the venture capitalists would want to sell earlier or not sell, you know, and they'd have all kinds of liquidation privileges. You don't want to get up to the closing and you've opened the champagne and you're raising the glass on a $51 million deal that you're going to split, and one guy says, I don't want to do it. The reason I didn't want to do it is he really never wanted to work for a large company. He was kind of king of the hill of this company. He was up in Vancouver, Canada. But if he worked for a big company, he's just going to be a brick in the wall. The money wasn't that important to him. So check your alignment with shareholders. Contact at the wrong level. The people you know in Microsoft or Oracle or Google or Salesforce is at a different level. You have to go to the top through the board or through their investment banker. Improper research of potential buyers. You really didn't know what their strategic vision was and how you could fit into that. You can go with a very strong story if you've done your homework. Misunderstand your buyer's process and timelines and models. How do they pay? How long does it take? You heard somebody say they may not get back to you just because they're busy. They're busy buying other companies. They may be busy selling, by the way. Inability to portray value properly. We had a company we took to market, and in the first wave of dialogue, he said, well, this is what's really valuable about us. And we said, well, you know, you kind of mapped to one of these new trends called the cloud. Don't you think? Yeah, actually, I might. Let's put cloud in there. Big difference in response. Improper due diligence preparation. You're not ready. That doesn't mean you're going to have all the answers. You'll still have problems. You'll have questions about your accounting and questions maybe about some contracts and a little bit of questions maybe about IP. I hope you address. But at least know what the questions are going to be and say, we're working on that. Here's going to be our solution. Because they can frame almost anything as a business case, business risk, okay? What's it going to take to get around this in the contract? The ones that we worry about are the IP, control of the IP, and a weird one is antitrust for small companies, but that'll come up. Not qualifying the buyers. We talked about that. Not orchestrating all buyers properly. One of the biggest mistakes, great, I'm going to go to market. And we're going to go to Brent's company because we're a competitor and say, Brent, do you want to buy me? We know each other. I think we can work together. What do you think? Brent then says, okay, let's go have a beer. He makes me an offer. Now what do I do? I say, Brent, just sit tight because there's a bunch of other guys I want to talk to. All I'm going to do is piss him off. So I want to talk to Brent when? Last. Brent, by the way, we've been approached, and it's a serious approach, one by a private equity group, and the other one by a firm you may know. It's an international firm. Frankly, you're the guy that I'd like to work with because I've always thought that if I sold to somebody, it'd be you. Of course, you say that to everybody else, too. All right. So you got to orchestrate them. Ego, greed, arrogance. The two dominant emotions involved in merger and acquisition, and you saw it play out here, is greed. What's the other side? Fear. Greed and fear. Greed and fear. You'll always be greedy. I want more. Oh, the deal may not happen. Fear. Greedy. Fear. It always goes back and forth. And that hasn't changed. Some value destroyers, you can go through this and you can get badly hurt. Confidentiality, internally or externally. Theft of technology. A lot of people, and they're kind of notorious for doing this, they're going after you and they're showing a great deal of interest just to get your technology, or at least some idea of what your technology is. Who are your customers? Who are your leads? You may have to go into the negotiations and they can't even see who your leads are. They can't see your technology, who your users are. You'll have to have an outside group that you both agree upon, give an opinion, and then they'll get to see what they bought when you finally sign the contract, okay? Loss of staff. They'll go after your staff. Where? This is huge. It's much tougher now. We work with smaller, generally under $100 million. Some are larger, privately held software, IT, related technology companies. They're not complete companies, and so we have to put 5 people in the account, researcher, writer, evaluator, and 2 point guys, because you can't have the CEO be worn out. You don't want to be in the middle of this and find a drop-off in business, all right? And then going to market too late. Going to market too late. It's interesting on timing, back to timing. Going to market too late clearly will kill you. Going to market too early, actually in some cases, it's that time when they talk about where you get a chance to get to know them. You heard that from a lot of people. You know, we knew these guys for years. Well, this is one way to get to know them. Leverage the process, maximum value. I'm going to tell you how you can get to know people. When you go to market, this is something that's not as well understood as it should be. I see people say, well, we did some soft contacts. We made a few phone calls. Well, you really didn't get into it. You really weren't committed, all right? And did you guys see the movie Lincoln? Okay, what did you think about that movie? I thought it was amazing. I mean, just amazing. So I asked my wife afterwards, I said, what'd you think? What struck you about that movie? Because it's incredibly entertaining. You've got to see this, and the acting is just unbelievable. And she loves Tommy Lee Jones. But it was interesting because there's this guy, Lincoln. I mean, he has all the credibility in the world, but he was totally focused. And what she said to me was, well, there's no noise. There were no airplanes or cars or TV or radio or mobile phones going off. It was absolutely silent all the time, other than the clopping of horses and, you know, splashing of mud. And there's this horrible time, most horrible time in our history going on. And here's a guy who was totally focused on one thing, and the odds were against him. And you hear about the power of your intent changing things. And you hear about the power of your presence changing things. And oftentimes, the difference between success and M&A is just that. You're too casual. Well, let's just go check in and see if somebody wants to pay a lot of money for me. They want to see that your intent, all right, on this. They want to see your presence, all right. This is done where you have to get out and build that trust, all right. They all talked about trust. How do you think you do it? This process builds trust. It shows professionalism. It doesn't leave any stone unturned. You do a global search, and it will make a huge difference. But if you do it, I want you to be totally committed. I want you to be like that character in the movie. Now, when you go to market, there's something you have to remember. What you're used to doing is you're used to dealing at a certain level, maybe reselling or licensing, you know, your product or whatever to some of these companies. You might have done some joint ventures with Microsoft, okay? And the joint ventures go to a different level. And if I say to Brent, you know, I want to do a reselling license, he'd say, well, Bruce, I got guys that do that. Go talk to them. Joint venture, go talk to the head of R&D. The question is, do you want to buy my company? Now I've got Brent's attention. Because one of his jobs, and it's the job of every technology entrepreneur believes this, is that I'm a builder. I'm a builder. They pay me a lot of money to build here and to stay ahead of competition. And I will pay attention, and they do pay attention, all right? And you oftentimes you find companies missing this dynamic. They went at the wrong level, or they didn't take the opportunity to reach out to a broader base. And you mentioned, what were the stats? 40% of the responses, Rob, and 25% of the deals comes from firms in the B list you may never have heard of, okay? But if you don't reach out at this one moment in time to these firms, you won't know if they're interested. You won't be able to create that bridge, all right? So please do this. It's too important. Reach out, because the CEO will listen. It's the only time you get the chance to do that. There's some benefits to the process. If you do it this way, if you have a process and you have the right resources and you got a database that can help you out and everything, is first off, when you go through this kind of preparation, you'll forge a better business model, because you're asking yourself the exact same questions that they're going to ask you that maybe a business consultant would ask you, aren't they? They'll ask you about contracts. They'll ask you about how you're protecting your IP and how you're paying your employees, how you're dealing with problems, how you're handling pricing, ongoing revenue. They ask you all these questions that you need to answer. And implicit in answering those questions is that you should have asked yourself those questions a long time ago. All right? You'll run a better company. You'll have a better model. Because they're going, they're hoping to buy companies, it's mapped against some of the best practices out there. This next one's interesting. You will, kind of like that guy who, well, did you think about maybe you're a part of the cloud? All right? By looking at competition and crafting your presentation about your position, you will have a better position. I do this stuff for a living. I've been doing it for 27 years. I've sold nearly 300 companies. We run hundreds of thousands, actually, of conferences. I learned a lot today. All right? There's always something. All right? But it will, when you reach out and when you do the research seriously, you're better in your position. You'll be more valuable, all right? They'll respect you. You know your stuff. This is an interesting one, market feedback. I didn't expect this. I was selling a company many years ago, and I use this as an example, that they did a technology for your portfolio. And I was sitting on the other side of the conversation with Michael Bloomberg, and he was on the cover of Fortune magazine that week. And I thought, I'm a lucky guy to be able to talk to Michael Bloomberg. And then I realized that Michael Bloomberg is very, very efficient and very professional. He said, we looked at your stuff, Bruce. I love it, frankly, I love it. But let me tell you the issues, what we see about the market, and I would buy it except that our guys think they can do it themselves, and I've given them the green light, so we're too far along. But if they don't make it, I'll be back at you. I sold the company to Reuters. But what was the market feedback there? Because I was getting that from a lot of people. It helped us position the company. It helped us in final negotiations. We learned a lot about where we were and our competitors and what the buyers were thinking in the marketplace. What was that worth? What's that? It's the best market feedback I've ever gotten. The next one's really interesting. I used to wear a watch. I just go like that, and it's like my kids now. I don't wear a watch. We're at 5 o'clock. We'll be there. We'll be there. And this is an interesting story, but we took a company out. It was our very first company. We did some strategic work with them. A guy named Jack Grushko, and Jack had a technology that. It was a utility on DOS. I mean, this dates me, okay? And he had this, the box looked like Geppetto's workbench, and he had the advanced version. But he had venture capitalists from hell. And Jack wanted to raise some money because Jack was a consummate technologist. He and his wife were both, PhDs from like MIT or something. And Jack saw the future. And he had done some kind of side work for American Airlines on communication. And he wanted the venture capitalists to fund that. And they said, no way. He's up in Vancouver, Canada. And he says, Bruce, what should we do? They're going to block anybody coming in. That's why I thought I thought it was brilliant having the guys go through that. It put some life to those issues, gave some life to those issues and meaning. But so maybe, Jack, what we do is, would the board agree to sell the asset and then take the money for this new technology? By golly, they said yes. And then Jack said, well, I got to find somebody to help me sell it. We couldn't find anybody. And Corum was just doing strategic work, so I said, hey, Jack, I'll help you. I love this stuff. And so we kind of made our list, checked it twice, and then we said, there's probably a lot of other people who might want this. The B list. The B list. We went out, worked really hard, got about 12 interested parties. First thing we noticed is who they were. Back to Rob's point, little short of half was that B list that we made up kind of as an afterthought. All right? But what else was interesting later on? Only 25% of them, 3 of the 12, would be eventual buyers. But the other guys were interested. They wanted to maybe invest in Jack's company or do a joint venture or license some of the technology for their customer base. That was interesting. That was really interesting. So doors are opened. Really great entry to these guys for business relationships. Let me show you how that comes back. And of course, the end game is you want an exit. That's what this is about, growth and exit strategies. Exit's the end game. So let me take a case study, a little company Nat sold. And it's, oh, by the way, I got to tell you what happened to Jack. I always forget this story. So Jack, we did sell the asset. We sold it to a company called Central Point in Portland. And Portland then sold to Norton Utilities, which is part of Symantec. So Symantec's utilities include stuff from Jack's little company. Then Jack took that technology and he built it up. And then he was bought by a firm 128 miles south of him. Who's 128 miles? Big. Think real big. Microsoft. And the technology had been renamed, and it was called email. So Microsoft's first email offering was Jack's company. Anyway, so to kind of take this idea about the process and the importance of it and how you can benefit, first off, I'm going to take a company that Nat sold in Portland. They had $3 million in revenue. It's pretty small, but kind of cool stuff. They thought maybe $5 million would be good. We thought we were doing okay to get $5 to $8 million. We got 2 offers. Okay, the deals fell apart. That happens. And you heard that from the speakers, that sometimes these deals go through, kind of a life cycle, and they fall apart, and you have to go back. One case, the stock of one of the buyers went in trouble. There was an investigation or something, and the other one, the champion we were dealing with, the guy who knew everything, left the company. So we went off the market into a process called hiatus. They learned a lot in the process. All right. They positioned themselves better, and it opened a ton of opportunities to them. Some of those people that approached them, not these 2 guys, but the others, they did 4 or maybe 5, I can't remember, joint ventures, which dramatically increased their value. We took them back out. We re-entered them about 18 to 24 months later. Now they were big enough and interesting enough that we got the private equity guys bidding against the strategic guys, and we did a 90% recapitalization at a $40 million valuation. This is sometimes what happens, but the process opened doors for them, made them smarter. They listened, okay? And then that private equity firm sold it later for $100 million, and they were still a 10% owner. Now, the interesting thing about this is that we then, because based on that experience, we went out to market and took a company that's much bigger, and they sold for 0.6x, near a $90 million company, okay? I was 3 or 4 times multiple to 0.6. The market had changed. They missed the market. So I'd rather be too early and build those relationships, all right, and learn something in the process. So the market consolidated. In a global search, we'll close with just a couple of statistics. I've heard it bandied around today about why you want to talk to other bidders. And we've been mapping this for a long time, done 275 deals. I think that's more than probably anybody. And so what percentage of the time will other buyers be willing to pay more than the first party that approached you? Because we get these people, and they come in, and they actually have the offer. Just sign it. What do you think, Bruce? Should we sign this? Is this the right time, the right buyer, right price, right structure? Boy, I've been to your conference, buddy. I'd just love to get this done. It's nice to be courted. I'm nervous. What do you think? Don't sign. Because 75% of the time there's somebody willing that will buy you. It'll be 75% of the time somebody's out there that will pay more to be that eventual buyer. Now, what is the average improvement if you go through the process properly, as I kind of outlined at the 8 steps? What is the average improvement in the value of the deal? If you global search, get everybody involved, what's the difference? How much better is it? So what is the average improvement from first offer to LOI? That very first offer that kind of got the process going. That's about 70% of our deals. I agree with the first panel here and the angel guys. By having an auction environment, 48%. That's a good tone to leave it on. Okay? Thank you very much.